Charlie Munger sat in his favorite chair, the one made of leather worn by time, leafing through a book on quantum physics while waiting for the start of yet another annual Berkshire Hathaway meeting. At 99 years old, he still maintained the same voracious curiosity that had accompanied him since childhood, that insatiable hunger for knowledge that would transform a lawyer from the American Midwest into one of the most respected investors in the world. But few truly understood what made Charlie Munger so special. It wasn't just his billions of dollars or his legendary partnership with Warren Buffett. It was something much deeper, something that most people simply ignored. Charlie's story began in Omaha, Nebraska in 1924, at a time when America was still recovering from the echoes of World War I. His grandfather, Thomas Charles Munger, was a prominent federal judge, and his father, Alfred Case Munger, worked as a lawyer. Growing up in a family of lawyers shaped in Charlie an appreciation for logic, rigorous argumentation, and structured thinking. But young Charlie didn't want to simply follow in his ancestors' footsteps. He wanted to understand how the world really worked, not just how the laws said it should work. During his formative years, Charlie developed a habit that he would maintain throughout his life. He read voraciously, devouring books on a wide variety of subjects. While other boys his age played baseball or chased girls, Charlie could be found in the local library, lost in volumes on history, science, mathematics, and philosophy. His teachers noticed something peculiar about him. The boy not only memorized facts, he connected ideas from different disciplines, creating a web of knowledge that would become his greatest tool in adulthood. When World War II broke out, Charlie interrupted his studies at the University of Michigan to serve in the Army. He worked as a meteorologist, an experience that taught him valuable lessons about probability, uncertainty, and the importance of making decisions with incomplete information. These lessons would become fundamental to his approach to investing decades later. After the war, Charlie was admitted to Harvard Law School, although he never completed his degree. He graduated magna cum laude, but something inside him already knew that law, while fascinating, would not be his final destiny. Back in California, Charlie established a successful law firm. He was brilliant at his craft, able to dismantle opposing arguments with surgical precision. But legal work, however lucrative, did not completely satisfy him. Charlie observed his wealthiest clients and noticed something interesting. Many of them had built fortunes not through salaries, however high they were, but through smart investments and business ownership. This observation planted a seed in his mind. In 1959, the encounter that would change Charlie's life forever took place. During a dinner in Omaha, he was introduced to Warren Buffett by a mutual friend. Warren was 29, Charlie was 35, but the two connected instantly. They talked for hours about investments, business, books, and ideas. Warren was impressed by the breadth of Charlie's knowledge and his ability to think through complex problems. Charlie, in turn, recognized in Warren an exceptional talent for analyzing companies and evaluating investment opportunities. Inspired by Warren and the possibilities he saw in the world of investments, Charlie decided to form his own investment partnership in 1962. Wheeler, Munger and Company would operate for the next 13 years, generating compound annual returns of approximately 20%, significantly higher than the market. But Charlie wasn't just making money. He was developing an investment philosophy that challenged the conventional wisdom of his time. Most investors in the 60s and 70s followed the efficient market theory, which suggested that stock prices already reflected all available information and that it was impossible to consistently outperform the market. Charlie rejected this notion. He believed that markets were often irrational, driven by human emotions such as greed and fear. More importantly, he believed that through disciplined study and clear thinking, it was possible to identify excellent companies trading at reasonable prices. But here was the insight that most people ignored. Charlie didn't believe that success in investing came primarily from complex mathematical formulas or sophisticated algorithms. He believed it came from something far more fundamental, a robust, multidisciplinary mental model for understanding the world. Charlie studied psychology to understand the cognitive biases that led investors to make bad decisions. He studied physics to understand concepts like momentum and inertia in business. He studied biology to learn about complex adaptive systems. He studied mathematics to master probability and game theory. Charlie developed what he called a lattice of mental models, a framework of interwoven mental models from multiple disciplines. He argued that most people tried to solve every problem with the tools of their own discipline. An engineer saw everything as an engineering problem. An economist saw everything through economic lenses. But Charlie believed that the real problems of the world were multidimensional and required insights from multiple fields of knowledge. One of his favorite mental models came from evolutionary biology, the concept of natural selection and competitive advantage. Charlie applied this concept to business, looking for companies with economic moats, protective moats that prevented competition from eroding their profits. These moats could be powerful brands, network effects, economies of scale, or proprietary technology. Companies with wide and deep moats could maintain high profit margins for decades, generating extraordinary returns for their shareholders. Another crucial mental model came from physics, the concept of potential energy versus kinetic energy. Charlie saw some companies as possessing tremendous potential energy, latent value that had not yet been realized. Perhaps the company possessed valuable assets being poorly managed, or perhaps it operated in an industry on the verge of transformation. Investors who could identify this potential energy before it converted into kinetic energy, real financial results, could profit enormously. From psychology, Charlie absorbed the concepts of confirmation bias, anchoring, loss aversion, and dozens of other cognitive biases that distorted human thinking. He realized that these biases affected not only individual investors, but also corporate managers, Wall Street analysts, and even himself. The key was not to eliminate these biases, that was impossible, but to recognize them and build systems to mitigate them. Charlie kept checklists, cultivated a circle of trusted advisors who would challenge his thinking, and practiced what he called inversion thinking. Inversion thinking was particularly fascinating. Instead of asking, "How can I succeed as an investor?" Charlie asked, "How can I ensure that I fail as an investor?" The answer was clear. Being impatient, using excessive leverage, not doing proper homework, letting emotions guide decisions, not learning from mistakes, operating outside your circle of competence. By clearly identifying the paths to failure, Charlie could systematically avoid them, greatly increasing his chances of success. The concept of the circle of competence was another pillar of Charlie's thinking. He believed that each person had areas where they possessed genuine knowledge and a competitive advantage, and areas where they did not. The secret wasn't expanding his circle of competence to include everything, but knowing its boundaries with brutal precision. Within his circle, Charlie could operate with confidence. Outside of it, he would simply say, "I don't know," and move on to the next opportunity. This discipline saved Charlie from countless disasters that destroyed other brilliant investors who ventured into uncharted territory. In 1978, Charlie officially joined Berkshire Hathaway as vice chairman, formalizing his decades-long partnership with Warren Buffett. Together, they would transform Berkshire from a dying textile company into one of the world's most valuable and admired conglomerates. But Charlie's contribution went beyond simply selecting good investments. He fundamentally changed Warren's investment philosophy. In his early years, Warren followed the approach of his mentor, Benjamin Graham, focusing on cigar butts, cheap companies trading below their liquidation value. The idea was to buy for 50 cents what was worth $1, sell when the price approached the real value, and move on to the next opportunity. This strategy worked, but it had limitations. Truly cheap companies were usually cheap for good reasons. They were mediocre businesses in declining industries. And after buying these companies, Warren needed to resell them, generating taxes and forcing him to constantly seek new opportunities. Charlie convinced Warren of a different approach. Instead of buying mediocre businesses at bargain prices, why not buy excellent businesses at fair prices? Truly great companies with sustainable competitive advantages and honest, competent managers could be held forever, compounding their profits year after year, decade after decade. Charlie summarized this philosophy in one of his most famous phrases: "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." This shift in philosophy led to some of Berkshire's greatest successes. The purchase of See's Candies in 1972 for $25 million was a turning point. See's wasn't cheap by traditional metrics. It traded at multiples significantly above what Graham would have considered acceptable. But See's possessed something special, a beloved brand with pricing power, loyal customers who returned year after year, and the ability to raise prices without losing sales. In the following decades, See's would generate over $2 billion in cumulative profits for Berkshire, spectacularly validating Charlie's vision. But what truly set Charlie apart wasn't just his specific investment choices, it was his broader framework of thought. He frequently spoke about the importance of deserving trust. In a world where many in business operated on the ethical edge, where shrewdness was admired and cheating was acceptable as long as you didn't get caught, Charlie was uncompromising about integrity. He believed that reputation was an asset that took decades to build and minutes to destroy. Companies and individuals who operated with absolute integrity had a tremendous competitive advantage in the long run. Charlie also emphasized the power of patience and compounding. He liked to quote the rule of compound interest. If you get 20% returns a year, your money roughly doubles every 3.5 years. Held for decades, the results become astronomical. But most investors couldn't maintain that patience. They got bored, chased the next hot stock, traded frequently, paid taxes and fees, and ended up with mediocre returns. Charlie called this the action killer of inaction, the inability to simply sit back and wait. One of Charlie's most counterintuitive lessons was about the value of saying no. He and Warren rejected the vast majority of opportunities that came their way. Of the hundreds of proposals they saw annually, they might invest in one or two. This extremely high rejection rate scandalized many observers. How could they pass up so many seemingly good opportunities? But Charlie understood something fundamental. In life and in investing, you don't have to swing at every ball. Unlike baseball, where 3 strikes and you're out, in investing, you can let thousands of opportunities pass and simply wait for the perfect one. And when that perfect opportunity appears, you can swing with all your might. Charlie also developed profound insights into the nature of suffering and how to avoid it. He observed that most human miseries were self-inflicted. People destroyed their lives through addictions, envy, resentment, self-deception, and an inability to learn from mistakes. In business, companies self-destructed through greed, excessive leverage, poor governance, and perverse incentives. Charlie saw his role as identifying and avoiding these pitfalls, both in his personal life and in his investment choices. He had simple but powerful rules. Never lie, not even a small lie. Never steal, not even a penny. Associate only with people of exemplary character. Live below your means. Keep learning throughout your life. Admit when you're wrong quickly and change your mind when new evidence emerges. Don't envy the success of others. These rules may seem simplistic, advice a grandma might give, but Charlie saw them as fundamental to a successful and fulfilling life. In the world of investing, Charlie was equally straightforward. He advised investors to keep costs low, avoid excessive trading, focus on the long term, and truly understand the businesses they invested in. He warned against using leverage, which he saw as a near-guaranteed way to eventually blow up your account. He mocked most hedge fund and mutual fund managers who charged exorbitant fees while delivering mediocre returns. He suggested that most people simply invest in low-cost index funds and forget about them for decades. But for those willing to do the work, Charlie offered a different path. Study broadly, develop multiple mental models, deeply understand a small number of excellent businesses, buy them at reasonable prices, hold them forever, ignore daily market fluctuations, and let compounding work its magic. It was simple, but not easy. It required discipline, patience, and the courage to go against the crowd. The Berkshire Hathaway annual meetings became legendary, largely due to Charlie's performances. While Warren spoke eloquently about investments and business, Charlie offered concise, often hilarious, and always insightful comments. His favorite response was simply, "I have nothing to add. usually after Warren had spoken for 15 minutes on some topic. But when Charlie actually spoke, every word carried weight. He could distill complex issues into fundamental principles, cut through obscurities, and get straight to the heart of the matter. Charlie was also not afraid to criticize business practices he considered questionable. He attacked excessive CEO compensation, calling it legal but immoral. He condemned companies that manipulated their accounting numbers to artificially inflate profits. He ridiculed investment bankers who pushed bad deals to collect fees. He warned about the dangers of complex derivatives, calling them financial weapons of mass destruction years before the 2008 financial crisis validated his fears. During that crisis, while many sophisticated financial institutions collapsed, Berkshire Hathaway remained solid. Charlie and Warren's conservative, long-term focused approach, which many had ridiculed as old-fashioned during the boom years, proved to be exactly right. They had avoided the exotic financial products that had ruined so many others. They had maintained substantial cash reserves, allowing them to invest aggressively when others were desperate for liquidity. And they emerged from the crisis stronger than ever. As Charlie aged, he only became more insightful. In his 80s, 90s, and even in his final days at 99, his mind remained razor-sharp. He continued to read voraciously, learning about new technologies, understanding new industries. Many people his age were mentally retired, revisiting old memories and repeating old stories. Charlie remained curious about the future, enthusiastic about new ideas, willing to change his mind when confronted with better arguments. This willingness to continuously learn and adopt was perhaps the most important lesson Charlie offered. The world was constantly changing, new technologies emerging, new industries being created, old certainties being questioned. Investors and people who stopped learning fell behind, unable to recognize new opportunities or avoid new pitfalls. But those who kept their minds active, who continued studying, questioning, and growing, could thrive through any environment. Charlie also offered profound lessons about happiness and the meaning of life. Despite having amassed a fortune estimated at billions of dollars, he lived relatively modestly. He had lived in the same house for decades. He drove ordinary cars. He did not flaunt his wealth or seek social status. What brought Charlie joy was the intellectual game of investing, the satisfaction of solving complex problems, the pleasure of stimulating conversations with intelligent people, and the joy of seeing well-run businesses thrive. He often spoke about the importance of working with people you admire and respect. Life is too short to spend your time with people you don't like or in jobs you hate, even if they pay well. Charlie was fortunate to spend decades working side by side with Warren Buffett, someone he genuinely admired and liked. Their partnership was a model of how business relationships could be conducted, based on mutual trust, intellectual respect, and shared values. In his later years, Charlie began to reflect more explicitly on his legacy. He knew he had been extraordinarily lucky, born in a wealthy country at a time of increasing prosperity, blessed with unusual health and longevity, and gifted with an exceptional mind. But he also believed he had used these gifts responsibly. He and Warren had donated billions of dollars to charity. They had built a company that employed hundreds of thousands of people and treated them fairly. They had generously shared their investment philosophies, helping millions of people invest more intelligently. But perhaps Charlie's greatest legacy was his framework of thought, that structure of multidisciplinary mental models that he had spent a lifetime developing. He didn't keep this knowledge to himself. Through his speeches, interviews, letters to shareholders, and Berkshire's annual meetings, Charlie generously shared his ideas with anyone willing to listen. He deeply believed that good ideas should be disseminated, that knowledge should be shared, that raising the level of general wisdom benefited everyone. Many people listened to Charlie, agreed with his ideas, and then did nothing with them. This was the tragedy he repeatedly observed. It wasn't enough to simply know the correct principles. You needed to internalize them, live them, apply them consistently over decades. Most people sought shortcuts, secret formulas, ways to get rich quick. Charlie offered something different, a difficult but proven path that required disciplined study, clear thinking, extreme patience, and absolute integrity. When Charlie Munger passed away in November 2023, just weeks shy of his 100th birthday, the investment world lost one of its greatest thinkers. But his ideas have lived on, preserved in countless recordings, transcripts, and books. And for those willing to study them seriously, apply them diligently, and incorporate them into their lives, these ideas continue to offer a blueprint for success not only in investing, but in life. The secret that most people don't know about Charlie Munger wasn't a secret at all. It was completely public, repeated time and again. The key to Charlie's extraordinary success was his commitment to continuous, multidisciplinary learning, his devotion to clear, rational thinking, his exceptional patience, his unwavering integrity, and his intellectual humility. These qualities are accessible to anyone. They don't require innate genius, special connections, or substantial initial capital. They require only decision, discipline, and decades of consistent application. Charlie Munger proved that it is possible to think better than most people, invest better than most investors, and live a life of meaning and satisfaction. He did not do this through tricks or shortcuts, but through the rigorous application of solid fundamental principles throughout almost a century of life. His message to future generations was clear: study broadly, think clearly, act rationally, live with integrity, and be patient. The rest will take care of itself. And so, as the sun set on an extraordinary era in investment history, Charlie Munger's lessons remained, ready to be discovered and applied by anyone willing to do the work. There are no shortcuts to genuine success, but there is a proven path illuminated by those who came before. Charlie spent his life mapping that path and generously sharing the map. The only question that remains is how many will have the wisdom and courage to follow it.
Check out these other videos and keep learning.